Ndachokanganwa chirungu chacho chandinoda kutaura. Ndotaura kuti chi?
Transcript and recording has started. That's the recording started, guys.
Tazoshaka ukupedza zvinhu zvemwana mufungwa. Sadaro so.
Sorry. Pedza chirungu chekuintroduce.
Ataso kana upedza unongoita handover kuna rubwacho obva ango conclude. Ongotaura this is the end of our presentation chichi.
Aiwa, taso anongopedzisa maendover ndogona kunge ndarara. Guys,
aisingo yekurara Ruby. Chimira chingopedza.
Guys, amutombondinzwisisa. Ndogona kutosara ndiri ndega meeting.
All right, it's fine. I'll wrap up. This is the end of our presentation. We what. So it's not a problem. You know, sir, no doza akwewo, but no bo. Unongo kamukirira rushomo wakainga pachuri. Bo.
Sei yako isiri kunyatsooneka.
Chichiri kuoneka.
All right, zvakuita. Tichitanga.
Ngatitange. Warekoda? Tofamba.
Okay, good day to you. My name is Ruby Marufu, and I'll be introducing the Group 2 members. We've got Tobias Ngoshi, Moja Mtizira, Salom Ngandini, Tawanda Ngandini, Francois Mandiambira, Tavonga Audrey Chivenge, Mishek Mundoa, Jeffrey Hlakanyani, and Simbara Shemaunga. I'll take this moment to hand over to our lead presenter, Taso, to take us through the rest of the presentation. Thank you.
All right, thank you, Ruby. So I will just present on what we did. Since we are group number 2, we'll take on question number 2. So what we did, we have already we've already done our calculations, and what I'll be doing is just to explain. So our question reads, that's for the group 2. Provided is market data for platinum and silver prices over the years. Then the question requires us to record ourselves and including other group members for each questions, which are outlined below, which we are going to tackle one by one. Okay, so the first question requires us to calculate the averages annual platinum and silver prices from 1980 to 2022. So we first look into our data. We have the data for platinum is in this form, where we have the date in this column B. Then we also have the high, low, and average price. And also here we can see that the trading is split into 2 parts: the AM, which is the morning trading, and the PM, which is the afternoon trading. So in each section we have the high price, the low price, and also the average one. Then the same applies for silver. So what we are going to do is first to organize our data so that we have our annual data. So we come to this, that's where we organized our data. We see that for platinum price, our data is starting from 1980, that's from 1990. And we have the AM and PM price, as we have seen in this tab. Okay, so we have used some formula to pull our data together so that we have our annual platinum and silver prices. So this is the formula. I think you can see it here. That's the formula we used, and we dragged it down. So for AM, This calculate the average for 1990, and here's the figure up to the latest date, then also for PM. But since we are required to calculate the average for platinum, it means that first we have to calculate the average of, in 1990, we are going to calculate the average of AM and PM, which we calculated in this column, and we can see the column, the formula here, which is simply calculating the average of these two. Then we used the same formula to pull our data. That's for silver. So the formula gives us these results. So we now have our average prices column. So that means we have answered our part 1 question. So we simply use the average function of the Excel format. Okay. Then we move on to part 2, which requires us to display the prices of platinum and silver on a line graph and comment on the prices trends. So here that means we are now using these values, the average prices we calculated in these orange columns. So the graph is here. We used the combo graph, where we, on our primary axis, we put average silver price, average silver price. Come here. Okay, average silver price, which is the column F. Then also on our secondary axis, you put the average price platinum. So if we use the insert button in our Excel, and we pick these columns, our graph will come out like this. So we can see that these two average platinum and silver prices, they were moving in tandem in the same direction, as we can see here. That's for the blue line for platinum. Our prices are starting from 1990. That's why it's starting from here, I think, as you can see. Then from there, the average prices, they are moving together. We can see from 1992 up, we can see an upward trend up to 2007, then just a minor fall in 2000 for platinum prices. Then it rose again in 2010 when it reached the maximum. Then the price for both minerals started to fall up until 2019, and started to rise again up to 2021. So basically, it means we have answered the part 2 of the question to display the prices, and we have commented on the trend. Generally, we have seen that they are co-moving. That means they are moving together. Then we move on to question 3. Question 3, it requires us to calculate the annual log returns of platinum and silver prices from 1980 to 2020. So this one, we can see this, we labeled number 3 here, which is our log returns. Guys, confirm if you can still hear me.
Yes, we can hear you. You can go ahead.
Okay, thanks, Tobias. Okay, so on number 3, we've answered it from here. So the formula to calculate the log return, we have simply used this formula. We can see it in the formula bar. We used ln, that's log, can be used for log of, we said the log of the current price. For example, here we are looking at 1991, so the current price is 1991, then over the previous price, that's T-1, which is period 1980. And if we say enter and we drag it down, we will have the log returns for each period. As you can see, we don't have the value for 1990, because our formula is, we don't have the previous figure, that is 1989 figure, we don't have. So here we have the blank cell. Then for silver prices, since they are starting from 1980, we use the same formula. That's ln of the current price, which is 1981 over the previous price, which is 1980. Then you say enter, and we drag our formula so that it populates the log returns. So basically that's how we calculated the log returns. Then we move on to the next question, which is question number 4. It requires us to compute the arithmetic average returns of the individual minerals, and we comment. So we can see we have labeled it, our solution here, number 4, that's arithmetic average. Then for platinum, since we have combined the AM and PM, we just labeled it combined here, not to confuse other people trying to follow. So for combined, the average is here, and we simply use the Excel function average to calculate. So if you can double click here, we can see where it's picking the values, which is under the combined average. So we picked it up to 2022. And if we just press enter, we now have our average return, which is 0.023492, as you can see here. Then also we are required to calculate the average return for silver, and the same formula. As we can see, it's average. We use the average function, then we highlight this column with log returns for silver. So up until 2022, and we just press enter, we have our average return coming out here, which is 0.002088. Then also we are required to comment. So the comment for this average price for platinum, we have said on average, the average return of platinum over the period in question was 2.35%, implying that the price of platinum has generally increased by 2.35%, which is a positive return. Therefore, it means that the investors had a gain of 2.35%, which is a positive thing. Actually, it lures more investors since they are earning some fair value gains. Then the comment for this for silver average price is that on average, the average return for silver returns over the period in question was 0.21%, implying that the price of silver is generally increased by 0.21%, which is a positive return. Therefore, investors have gained by 0.21%. That is the fair value gains. So it means that buying these minerals is attractive to investors since they are positive returns. Then we move on to the next question. It requires us to, that's the 5th one, right? It requires us to calculate the risk of platinum and silver returns. The risk of platinum and silver returns. So our solution is here. We labeled it 5 risk. Then how to calculate a risk? We simply calculate the standard deviation. It measures the risk. So it's easy by using our software, our Excel. We just use this this formula here, that standard deviation for a sample, and we highlight. As you can see, it's picking the column for, that's for platinum. Let's start again. It's picking silver instead of platinum.
Yes, so you can just drag the formula, drag it to the right. Drag it to the left, sorry. Just drag it to the left. We can just correct that.
Oh, you mean like I can highlight this, then
Yes.
then I can, sorry.
Yes, let's continue.
Okay, that's fine. Okay, so let me just pick this and do this. All right. So we picked the wrong figure. So we now picked the right column. So we just click enter, and we now have the risk for platinum returns. Then for the silver, we use the same formula, the standard deviation. We right click it, we can see the formula, and it's picking silver. So this one is correct, and we just click enter. So you can see that the risk for platinum is 0.51. The risk for silver is 0.23. Generally, maybe we are not required to comment, but generally you can see the higher the standard deviation, it means the higher the risk. So here it means that it's riskier to invest in silver relative to platinum. So investors, wise investors would choose to invest in platinum, which has a lower risk. Okay, then we move on to the next question, question 6. It requires us to calculate the correlation between the two mineral return stock. Then do the two minerals have a diversification effect to an investor? Okay, this again using our tool Excel is an easy and very interesting one and less tedious. This one, if we double click here, we have used this formula to calculate the correlation. That's just Corel. Then we pick the two columns, that's for silver returns and platinum returns. We track down them up until 2022. Then by just clicking enter, we can now see the correlation, which is 58%. It's about 50%. Then we to answer the extension of the question, do the two minerals have a diversification effect to an investor? And here is our comment. There is no diversification effect since there is a positive correlation between the two minerals. Positive, we can see this figure is positive. The returns for both minerals, that's silver and platinum, are moving in the same direction. Thus, a shock in one mineral prices will also affect the other mineral in the same manner. That means there is no diversification, because where there is diversification, we need the correlation to be negative. Okay, thank you. Then we move on to our next question, which is question 7, which requires us to calculate the portfolio return. That is, we are given the assumptions that 70% of the investable funds are distributed to platinum and the remainder to silver. That means 30% have been invested in silver. So here is our solution. We have labeled here, that's a portfolio return 7. So how we calculate this? Actually, we are simply calculating the weighted return. We have already calculated the average returns. Now we just need to put these proportions into effect. So we have simply, as per the question, the proportion of the funds invested in platinum is 70%, then the remainder in silver, implying that 100% minus 70% is 30%. So we've put the proportions there. Then also we need the average returns for silver, for both silver and platinum. So here we just picked what we have already calculated. As you can see, if we double click here, we can see it's picking L3, of which L3 is here. We can see that's where we calculated our average for. That's our average. Actually, unfortunately, I think we've picked the wrong figure, but we can correct it. We are supposed to pick the one for silver, which is L5. So I'm just going to here, I say is equal to, then I go to pick L5, where is my L5? I go to pick, yeah, which is the average return for silver. I click enter. Then also to pick the one for platinum, it's L5. It had picked the wrong value, so we can simply correct it by say equal to. Then we pick L3. So we come here, we pick L3. That's for platinum. Yes. Then we just click enter, and we now have our values. Then the formula for calculating the expected return for a portfolio, as we alluded earlier on to say, is the weighted average. So here we calculate the weighted average. How do we calculate the weighted average? If we double click here, we can see what we did. We said the proportion of funds invested in silver, which is 30%, times the silver return, and we just click enter. So that means this is the weighted average for silver. Then also we need the weighted average for platinum. If we double click here, we can see where it's picking. The proportion of funds invested in platinum was 70%. We multiply it by the average return for platinum, which is here, and you just click enter, and we have our weighted averages. Then to have the aggregate value for the portfolio return, what do? We simply add the two. That is the weighted average for silver plus the weighted average for platinum, and click enter. So that means that we have calculated as per the requirements of the question to calculate the average return for the portfolio. So interesting, using our Excel, it makes our task easier. Then we go to our last part of the question. That's question 8. We are required to calculate the portfolio risk using weights in 7 above. So you have been given the weights, which is confirm if I'm still audible, team.
Yes, you are, Tessa.
Thanks, Salom. Okay, so here we are given the proportions. Silver, we agreed that is 30%, which is the remainder. Then platinum is 70%. So how we calculate this one? Actually, we are literally calculating the variance, the expected variance, since we have two assets here. So we are simply calculating the expected variance, of which we are simply going to say the weight for silver times variance for silver plus the weight for, sorry, actually the weight squared for silver plus the variance for silver plus the weight squared for platinum times the variance of platinum, then plus 2 times, we multiply the two weights times the correlation. Okay, so what we are doing here is to come here. Since in our formula we said we need the variance, so the variance for silver returns, we can simply right click here to see the formula we used, which is the var.s, using a sample, and pick the column with silver returns. As we can see, it's picking the silver returns there under I. Then also enter this our variance. Then for platinum, we double click it. We see if it's picking the correct column. Yes, it's picking the correct column. We say enter. Then also in our formula, we need the covariance. And it's easy for us because we Excel has an inbuilt function to calculate the covariance. So we type this formula, then we pick the two columns for the returns of both minerals. We just check if it's picking the right columns. Yes, it's picking the right columns. All the log returns are being picked. That's for silver and platinum. So we have the covariance. Then how to calculate the portfolio risk here? We have used this this formula. I'm seeing that we have made a mistake here. We have our weights, which we are going to multiply by respective variances. We have to square the weights. So it means we have to calculate the weights. There's a weight squared. So the weight squared, I can simply multiply the same weight by the same weight. Or I can put the square, where is the square here, where is to the power? Yeah, yes, this power 2. Yes, we want to square this weight. Yeah, that's how we square, right?
Yes,
that is
correct.
it. That's correct. You can go ahead.
All right, thanks. Then also we want to square the weight for silver. We can simply put this square, we say to the power 2. So to say the weight squared, this is weight squared for silver times the variance of silver, which is this one, AI 5, AI 6. Then over that plus the weight squared, which is AI4, just to confirm, AI4, yes, weight for platinum, we squared times the variance for platinum, here AI 7, yes. Then we say plus 2 times weight, times the weight of funds invested in platinum, times the weight of funds invested in silver, then times the covariance, which you have calculated here in AI, that's 9. Yes, then we just click enter, and we have our portfolio risk, which is merely a portfolio variance. Yes, so the variance here is 0.023. So thank you, team. I think this marks the end of my presentation. If you want to add something, you may add something. Yes, it's okay. If I may have maybe few comments, if they are there, you may just shout out, since I may not be able to see your hands. Is there any comment, Tobias?
Thanks, Tasso. I think you have wrapped it up. I don't have anything much, and I don't think members do have anything much to add. Safe just to thank you for a good presentation.
Indeed. Thank you, Tasso. That was well presented.
Thank you, Francois.
Thank you.
Thank you. So I
Thank
can't
you.
see any more.
Thank you, Tasso.
Thank you, guys. Goodbye. You may stop the recording.